Hello everyone, this is Tom Fox. I'm the Compliance Evangelist, and I'd like to welcome you to the October edition of 1 Month to a More Effective Compliance program. This is the only monthly compliance program focusing on a different subject, taking a deep dive so that it will help you have a more effective compliance program. This month, I will be talking about 1 month to more effective compliance for business ventures. But first, a word from this month's sponsor, the Volkoff Law Group.
Hi, I'm Mike Volkoff of the Volkoff Law Group and proud sponsor of this month's podcast series. The Volkoff Law Group believes that every company should have a robust ethics and compliance program. Experience and research show that ethical companies are better performers in the global marketplace. At ethical companies, employees believe in the company, they feel vested in the company, and are more productive. As a result, misconduct rates are much lower and financial performance is higher. We can help you achieve these benefits through an effective ethics and compliance program. The Volkoff Law Group specializes in corporate compliance, internal investigations, and white-collar defense. We are your partners in our joint mission of building an effective ethical culture for your company. Our 10 years experience shows that business cultures can change. We are committed to work with you to achieve an ethical culture in your company. We address your company's anti-corruption, antitrust, trade and sanctions, anti-money laundering, and other regulatory and legal risks. We do this through practical guidance that your company can easily implement. You can learn more about our commitment to effective ethics and compliance programs at our website, www.volkofflaw.com, our award-winning blog, Corruption, Crime, and Compliance, and our new podcast series of the same name. You can contact me at my email address, mvolkoff@volkofflaw.com. Let us know how we can help you achieve your goals.
Thank you, Michael. In this month's series, we will take a look at the role of compliance in mergers and acquisitions, the role of compliance in joint ventures, in joint venture agreements, distributorships, franchises, teaming agreements, partnerships, as well as other types of business relationships. At the end of October, you have an excellent grounding in what you need to do for a business venture under the FCPA. My 1 month series of 1 month to a more effective compliance program running through 2017 is a part of the Compliance Podcast Network. Day 14, Auditing Joint Ventures. Joint ventures provide many FCPA risks that other types of business relationships do not bring. For instance, the joint venture may interact with foreign government officials or employees of a state-owned enterprise, then leverage those relationships for an improper benefit, either through contracts or regulatory licenses, permits, or customs approvals. It is difficult to regulate a joint venture's interactions with foreign government officials when your partner is a state-owned enterprise or where the company is relying upon the knowledge of a local company for its contacts and business expertise. These risks are compounded when the U.S. company does not actually exercise control of the joint venture. It's further compounded by the fact there is no minimum threshold for FCPA enforcement action against a U.S. company for the actions of its joint venture in which it holds an interest. In that case, the entity must urge, beg, and plead for the majority partner to adhere to anti-corruption, compliance, standards, and controls. Often these requirements are established in the joint venture agreement, but success in securing contract protections depends on the importance of the global company to the joint venture itself. Another set of issues that comes from joint ventures is when it seeks to retain foreign agents or distributors. Depending on the amount of control, the U.S. company can usually impose its set of standards for conducting due diligence. The risks become more difficult when the joint venture partner brings to the joint venture a proposed third-party agent or distributor and vouches for that agent or distributor, proposed agent or distributor. If the joint venture partner is a state-owned enterprise, the issues become even more complicated as such referral creates an obvious red flag for government-sponsored referral. Now add on to the fact that the foreign joint venture partner may not be proficient in English as a first language. The U.S. company may not have the financial personnel with the requisite language skills in a foreign country. Some companies have a policy that English will be used throughout the world in its business dealings. However, even with such an English-only policy in place, the risk represented by such lack of effective oversight by the multinational extended only to the potential FCPA violations, but also to other corrupt acts such as kickback fraud and theft. At this point, you will have engaged in due diligence prior to the creation of the joint venture agreement. The agreement itself should have a robust set of compliance terms and conditions right up to the audit. Compliance expert Mike Volkoff has called the exercise of the right to audit one of the key elements in the risk management process around joint ventures. Any audit should take a deep dive into the payments made by the joint venture to a wide range of persons and entities, including agents, suppliers, customers, or others. This would be particularly important for the payments made to do business or otherwise operate legally in the joint venture's locations. This means there should be an inspection of the joint venture's books and records to see if facilitation payments are properly recorded as such. Volkoff noted that one interesting area which requires greater review is around payments to colleges or universities outside the U.S. If there are payments for research or other projects, you need to audit the payment and services with an eye towards determining the rate paid is not out of line with local payment rate. The same holds true around gifts and entertainment, as the local tradition for your foreign partner may be quite different than the expectations of an American company operating in a country such as China. Another area for audit is if the foreign partner receives a management fee, which can be used for improper purposes. Several FCPA enforcement actions were based on this or similar payment schemes. Such fees may be simply based upon a percentage of joint venture revenue or profit and are not often required to correspond with defined tasks, specific efforts, or hours. Most usually, there is no substantive billing associated with such fees. They simply become due. Under this type of arrangement, it is usually impossible to justify this fee if requested by the Department of Justice that you do so. If a foreign partner does receive such a fee, they need to be closely scrutinized in the audit process. You should use a wide range of investigative techniques in any audit of a foreign joint venture. That could be a trip to company headquarters, which would certainly be important, as on-site interviews with key joint venture personnel, such as CFO, CEO, head of audit, head of HR. Another important interview is for your head of sales, who might deal with foreign governments or state-owned enterprise. Phone interviews obviously can be used to supplement these in-person interviews where appropriate. What you're trying to do is put a product together that can stand up to DOJ scrutiny as well as SEC. Yet there are other key reasons for the audit. These include education, training, and communications. Every time you meet with someone, you not only have the chance to listen to them, but to give them information on the compliance program and your expectations. Equally important is the ease and hopefully comfort the participants in the joint venture will feel about your compliance efforts and their compliance obligations going forward. Finally, is your follow-up after the audit. If there are any red flags which were not fully investigated during the audit process, this must be accomplished in the follow-up phase. Additionally, if there are other action items for remediation, they should be completed in a timely manner. There may be some issues which bear greater scrutiny during the year, such as gift, travel, and entertainment expenses, and those obviously can be noted as well. So what are today's 3 key takeaways? Well, once again, it must be noted that joint ventures present unique risks under the FCPA and must be managed accordingly. The audit process is a key component of this. Number 2, think about who the final receiver, viewer, or reader of your report will be. And by this I mean, who's the final arbiter? Is it the Department of Justice? Is it the SEC? Is it your board of directors? I don't think this type of report would find its way into that of a judge, but it could under the right circumstances. So your final report needs to consider the final viewer of the document and who that's going to be and what's going to be persuasive to them. Finally, number 3, be sure to follow up on any red flags raised but not cleared and action items for remediation and or additional scrutiny. This is Tom Fox. I hope you've enjoyed Day 14 of 1 month to more effective compliance for business ventures, and I hope you'll join me tomorrow for Day 15. This is Tom Fox again. I'd like to thank you for listening to this episode of 1 month to more effective compliance for business ventures, and I hope you will join me again. If you have listened to this podcast on iTunes, I would greatly appreciate it if you would rate the podcast, as it would help in our rankings and help get the word out about the only daily podcast which will bring you a more effective compliance program. If you have any questions, you can email me at tfox@tfoxlaw.com. Once again, thanks to this month's sponsor, Mike Volkoff at the Volkoff Law Group. The podcast series, 1 month to a more effective compliance program, is a part of the Compliance Podcast Network. Please join us again.